How often does a doctor tell you that he gets half his surgeries wrong? How often do pilots claim to go wrong with their flight takeoffs 50% of the time? How often do sportsmen claim to lose 50% of their matches? They don't. They can't afford to. But an investor can. One of the most peculiar things about investing is that you can be wrong half the time and still do well. Legendary fund manager Peter Lynch famously said, "In this business, if you're good, you're right 6 times out of 10. You are never going to be right 9 times out of 10." Investors, keen to precisely judge the direction of the markets, assess potential small cap outperformance versus blue chips, or identify stocks that meet quarterly earnings estimates, need to understand this. There's only so much that they can get right. The appetite for risk is cyclical and transitory in the stock markets. It is intuitive to seek high returns from high risk investments like small cap stocks. It seems logical to expect volatile stocks to fetch better returns. But over a period, such strategies prove to be futile, especially when the bulk of the returns are lost in a sudden market crash. Investors often get swayed by the greed that small cap stocks offer. In a prolonged bull market, small cap stocks across the board tend to soar, most well beyond their fundamentals. The small cap valuations get frothy over time, yet investors pile on to the stocks in the hope that markets will continue to go higher. Eventually, investors go wrong, markets crash, and many lose their shirts. Now, what draws investors to small caps is the idea of fetching bigger returns from relatively small amounts of capital. And that is a perfectly good idea when stocks are cheap. But when the stocks of high risk businesses are valued at a premium with the assumption of steep earnings growth, they become double edged swords. A majority of small cap businesses lack fortitude, sustainability, and good governance. Hence, they tend to falter on investor expectations. And that is when their valuations come crashing like nine pins. For instance, consider the small cap rallies over the past 2 decades. From 2005 to 2007, from 2009 to 2010, from 2015 to 2017, and more recently from 2022 to 2025. In each of these cases, the small cap index outperformed the Sensex for few quarters. But eventually, after every market crash, every rupees 100 invested in the benchmark Sensex offered more returns than every rupees 100 invested in the BSE small cap index. The small cap to Sensex ratio is a crucial indicator for Indian investors, acting as a barometer for market sentiment and a guide for portfolio diversification. This ratio compares the performance of small cap stocks which have high growth potential but are also highly volatile compared to the stable large cap stocks that make up the Sensex. A rising ratio signals a bull market where investors are more willing to take on risk and seek higher returns from smaller companies. Conversely, a falling ratio suggests a move to safety, with investors retreating to the relatively low risk large cap stocks. The small cap to Sensex ratio is therefore an essential tool for investors to safely diversify their stock market exposure across market cycles. By monitoring the ratio, investors can make informed decisions about their asset allocation. When the ratio is low, it may indicate that the small caps are undervalued, presenting an opportunity for aggressive investors to increase their exposure for long-term potential growth. But when the ratio is high and small cap valuations seem stretched, it can be a warning sign to rebalance the portfolio by trimming small cap holdings and increasing exposure to large caps. Small caps tend to be safer when the small cap to Sensex ratio goes below the long-term average of 0.46 times. This is a yardstick we consider safe for recommending small cap stocks, even to relatively risk-averse investors. Now refer to the chart here. Simply plotting the small cap to Sensex ratio can give investors a sense of whether the small cap category is in the buy phase or not. In this chart, the term biphase depicts the periods during which good quality small cap stocks could have been bought at attractive valuations. So, is this the time for blue chip revival? Now, a disciplined approach helps manage risks as the stability of large caps can provide a buffer during market downturns, while small caps offer the potential for disproportionate returns during up cycles. But there is something that the small cap to Sensex ratio in India is not telling us. As few blue chip stocks in India grow significantly larger in size and gain global dominance, the small cap to Sensex ratio could remain skewed in their favor for years. For instance, the market capitalization of top 5 stocks in the US was 1.5 times the market capitalization of US small caps way back in the year 2000. In 20 years, that is in 2025, the market capitalization of the top 5 stocks in the US is 4.9 times the market capitalization of US small caps. Little companies are supposed to earn higher returns over time than bigger entities. But that hasn't been the case in the US for more than 2 decades. Since the beginning of 2014, the S&P 500 has grown at an average of 13.2% annually, while the Russell 2000 index of small cap stocks has gained just 7.2%. Much of that underperformance comes from underexposure of the Russell index to the market's hottest sector, technology firms. Tech firms constitute nearly 34% of the total market capitalization of S&P 500 versus less than 13% of total value of Russell 2000. Big stocks like Alphabet, Meta, Nvidia and Apple have all the momentum of artificial intelligence boom, and their global dominance has kept the stock prices soaring. So, an investor in the US waiting for the small cap to blue chip ratio to turn in the former's favor has waited disproportionately long. History suggests that if the market's biggest companies do stumble, the little guys might do reasonably well. But here, the global weightage of the handful blue chip stocks have made the ratio redundant. Hope you like this video. Thanks for watching.